Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hi everyone, Happy New Year. Welcome to ETF Spotlight. I'm your host Neena Mishra. This is the first episode of 2022 and I have two excellent guests today. In the first part, I'm joined by Todd Rosenbluth, Head of ETF and Mutual Fund Research at CFRA. Todd and I will discuss the market outlook for 2022 and also his top ETF picks. My second guest is John Davey, founder and CEO of Astoria Portfolio Advisors. Joining me now is Todd Rosenbluth. Hi, Todd. Welcome back. Great to have you on the show.
Thanks for having me. It's good to be with you in 2022.
Yes. So let's start with a little bit about 2021. It was a great year for stocks. Major indexes posted double-digit gains for the third consecutive year, and that was thanks mainly to ultra-accommodative monetary policy and a massive fiscal stimulus. Now, 2022 has started on a very volatile note because investors are, worried about inflation, rising rates, Fed, and Omicron variant of COVID-19. So I wanted to start with your thoughts on the market in 2022. What can investors expect from 2022 and how should they position their portfolios?
Well, we're certainly seeing a more volatile year to start 2022 than we ended 2021. We're likely to see we at CFRA think we're going to see single-digit gains for the broader S&P 500, which would be a much sharper rise or less of a rise than we saw in 2021. And we're likely to see the Federal Reserve raise interest rates a number of times. It's not clear how many. There's been talk of 3 or 4 possible rates or increases during the year. And that should certainly impact how someone would position their portfolio. They'd want to be aware of the interest rate sensitivity of the fixed income portion of the portfolio. We've been in an environment for low rates for so long that you get the income and you don't have to worry about the decline in bond prices as rates go up. That's likely to be a change in 2022. We're also likely to see continued inflation, which is going to be a positive perhaps for the more cyclical sides. We've seen growth historically do well, but we've seen values start the year strong. So most importantly, you have to not repeat the portfolio you had in 2021, expecting the same level of success and be aware of the risks that are tied to both your equity and fixed income portion of the portfolio.
Now, 2021 was a great year for the ETF industry as well, and that was thanks in part to the excellent performance by the stock market. So year to date, 2021 inflows exceeded $900 billion, and a lot of that money went into equity ETFs. And we know that investors prefer ETFs now because they are more tax efficient and usually cheaper than mutual funds. So we also saw sponsors converting their mutual funds into ETFs. Now, I was interested in your thoughts on 2021 ETF inflows and your forecast for ETF asset growth in 2022 and which areas will get a lot of new money in this year.
So, let's recap part of 2021. As you mentioned, over $900 billion of net inflows disproportionately towards equity products. But based on our data at CFRA, we saw a slight record being set for fixed income ETFs. We have $207 billion of net inflows that went in during 2021. But again, the equity products were considerably more popular and drove the record year that we saw in 2021. We think we're going to see an overall year of flows that is between what we saw in 2020, which was about $500 billion of net inflows, and the $900 billion that we saw in 2021, in part based on the stock market being up more modestly and there being more volatility. We think fixed income ETFs will have a place within the portfolio. They've started off the year a little bit lighter. We've seen some slight outflows to some of the products. That will recover. We'll just see investors rotate. So we think we're going to see a good year for the ETF market, one that would, in every other environment other than 2021, would be impressive because of the adoption that you talked about, both from investors getting more comfortable using ETFs and asset managers being more comfortable in offering those products. So a good year, not as impressive a year we saw in 2021.
Yeah, I agree. It would be difficult to repeat the performance of 2021. Now, 2021 was a record year for ETF launches as well. About 450 new products made their debut during the year, and some of them were very, very interesting. We saw the first metaverse-themed ETF, Meta. Then Vote was very interesting. Buzz was an interesting one. And we have seen that these newer products were more complex in general. They were focused either on very specialized niche themes. Many of them were derivatives based because we know that it is almost impossible for newer products to compete with ultra cheap beta products like VOO or VTI. So do you expect the record number of ETF launches to continue in the new year as well? And I was also interested in your favorite new ETFs of 2021.
So I think we're going to be hard pressed to have another record of launches in 2022. I think we're going to see continued launches. We've got some notable entrants that are lining up to come to market. Capital Group, for example, is set to launch their first ever ETFs that are going to be not identical to the American funds, active mutual funds, but run by some of the same people with the same broader investment style. We think those are going to be popular. We're going to see other more thematic-oriented ETFs, like what you touched on, not all tied to the metaverse, but various themes that we're seeing gain traction. We're likely to see more continued blockchain-related products. We're likely to see even some additions to the Bitcoin and crypto world through the futures-based products. So I think we're going to see more products. I don't know that it's going to be as strong. And we're likely to see some closures. We didn't really see much of that in 2021, but there's likely to be some closures, more closures in 2022, as if the market doesn't move up as high, then many of these funds that have come to market don't hit their asset minimums to be profitable. You asked about some of the exciting and new interesting products. I want to offer two different examples, and then maybe we can go and pull more if we need to. But inflation was an extremely popular investment theme in 2021. We saw strong demand for inflation-protected bond ETFs. TIP and VTIP were extremely popular from iShares and Vanguard. But one of the ETFs, in fact, one of the most successful launches in 2021 was an equity ETF, Horizon Kinetics Inflation Beneficiaries ETF. The ticker is INFL. It launched in early January of 2021. It actually just hit its 1-year anniversary as you and I are recording this. And it ended the year with over 800 million of net inflows. First ETF from the provider. It captured the investor interest because it was equities benefiting from the inflationary environment. So it captured active, it captured the theme of inflation. That was a strong start for this firm, and one we were quite impressed with. I'll give you a second one and then happy to pause and see if you for your own comments to it. We like what we're seeing in the ESG space when they're ESG versions of well-known strategies. And so Rspe is an Invesco ESG S&P 500 equal weight ETF. Now, Rspe is a highly successful product that has over $30 billion in assets. There's now an ESG version of these strategies. It follows in the footsteps of what we've seen with some of the market cap weighted versions of the S&P 500, but in an ESG lens. SN, Sam, Nancy, Paul, Elephant, SNPE, and then EFIV that have been successful in gathering combined over $1 billion in assets. So we think this Rspe product is compelling. It's quite small now, but I don't think that'll last.
Yeah, definitely very interesting products. INFL was, as you mentioned, one of the most successful launches of in 2021, and we had the manager on the podcast. So for our listeners who are interested in the strategy, please listen to that episode. Now, you mentioned Bitcoin ETF too, so let's talk a little bit about that ETF, because that was one of the most important ETF stories of 2021. The first US-listed Bitcoin ETF, BITO, the ProShares Bitcoin Strategy ETF, that made its debut, and it had a very successful debut. It was quickly able to gather over $1 billion in assets, and that was mainly due to this immense pent-up demand, and the ones that came just a few days later, they struggled to gather assets, and now Bitcoin and other cryptocurrencies have plunged. So investors are pulling money out of the product, and these are futures-based products, and it seems that investors really want is a spot Bitcoin ETF, because futures have these roll costs and liquidity issues. But so far, SEC Chair Gary Gensler, he doesn't seem to be in favor of a spot crypto ETF. He wants more clarity on regulatory jurisdictions. He has also mentioned the need for surveillance agreements with crypto trading platforms. So do you think we will see a spot Bitcoin ETF in 2022?
No, short answer, no, for all of the reasons that you touched on. I think the SEC and Gensler in particular has made it quite clear they are concerned about the underlying market. I don't have to agree with the fact that futures-based products are tied to that underlying market or not, and we have BITO that came to market, and now we have a few other products, and we have ETFs that are using the futures-based products. But I just don't think the SEC is prepared to move forward. I think Gensler continues to have concerns. So we would expect that we will not see a spot-based product in 2022. It'll happen at some point, either because Gensler's mind changes, because the environment is better, but I don't expect it to be 2022. I don't know what year and I don't know what date, but it's certainly not going to be 2022 in my opinion.
Do you think we will see more futures-based products this year? Maybe an Ether futures ETF or more Bitcoin futures ETFs? And again, that would depend on the path of the cryptocurrencies. If Bitcoin surges again, then probably we'll see more Bitcoin futures ETFs. But what about Ether futures ETF? Do you think we could see one this year?
We could. I have to admit, I don't know enough about the underlying market and how if the SEC is comfortable that the underlying market is large enough, not whether it's safe enough, but whether it's large enough. But the SEC certainly is more comfortable with futures-based products tied to commodities and cryptocurrencies than they are spot products. So we could see one, but I don't know enough to be able to go out on a limb and say we are going to see one.
Okay, so we talked about some of the important ETF stories of 2021, record number of launches, record inflows, Bitcoin ETF launch, Bitcoin futures ETF launch. We alluded to mutual fund to ETF conversions. Any other ETF story that surprised you last year? And I'll give one of mine. I was surprised by record inflows into the China tech ETF by Crane Kpw. This product was down about 38% last year. That was mainly because of a regulatory crackdown in China, but investors loved this product. They were pouring money into this ETF. It gathered more than 7.3 billion in assets last year. What about you? Did Kpw surprise you? Any other ETF story you'd like to talk about?
Yeah, I would agree. Kpw was certainly a surprise. Investors typically will use ETFs to get exposure to a theme that is popular and follow the trend, and often chase the wrong, for the wrong reasons. This was the opposite. Investors were trying to catch a falling knife again and again and again as things got worse. So it's extremely rare for an ETF to gain that much money while losing that much money for investors, not just on a one-off period, but throughout the whole year. So that surprised me. You touched on conversions, which we didn't expect to see that many of them and have that much success. We didn't expect to see as many of these new products come to market. I think inflation, I want to come back to it again, the inflation protected products have been around for years and have been a tool for investors to consider, but they haven't been the tool for investors to consider. And there was just really strong demand for the products overall. I guess if I can pivot to just a second one, I was impressed with the demand for thematic ETFs in 2021, despite the fact that technology-oriented thematic ETFs fell out of favor. So cloud computing, cybersecurity, other work from home related ETFs didn't do very well as the world seemed to be opening up. It may be pausing for a little bit of that as we start 2022. But we saw infrastructure related ETFs. We saw electric vehicle related ETFs. We saw lithium battery related ETFs be very popular. And Global X was one of the success stories in 2021 because of their broad lineup of thematic oriented ETFs. So I was hopeful that we'd see continued interest, but I'm pleasantly surprised with the stickiness to the overall asset base, even if we've seen rotation.
Yes, Global X definitely has a very interesting lineup of thematic ETFs, and the ETFs that you mentioned, the infrastructure ETF, the EV ETF, and lithium ETF, they all benefited from this massive infrastructure bill, or I should say law, which was the bill which was signed by President Biden, and that provides for more than $7.5 billion for a network of EV chargers and another $7.5 billion for zero emission or low emission buses. So obviously investors poured a lot of money into the broader infrastructure ETF, and then EV ETF and the lithium ETF too. Now the most important question, which are your favorite ETF picks for 2022? Which ETFs you are most bullish on?
So for perspective, we at CFRA have quantitative ratings on ETFs. We have coverage of about 2,000 overall products. So we have a wide number of products. So I'm going to pick and choose a couple of favorably rated ETFs that fit into some of the things we've already talked about, but now I can at least put some examples behind. So let me stick on the most recent topic we talked about of just infrastructure. We like the Global X Infrastructure Development ETF, PAVE, for the reasons that you cited, all the money that's being put towards building out infrastructure. And we also think industrials and materials are favorably positioned for a strong U.S. economy and to be able to do well in an inflationary environment. And this is an ETF that owns infrastructure companies in the industrials and materials space. I'll move off of thematic and just give something broader. We like quality stocks in this environment. We think that stronger balance sheets, companies with consistent earning streams, relatively stable business models are likely to hold up better and do better. And so there's a number of quality related ETFs. We've been highlighting the Fidelity Quality Factor ETF, FQAL, to our clients this month. But QUAL, which is an iShares product, or SPHQ, which is an Invesco product, those are all strong ones too. What we like about FQAL, in part, the Fidelity product, is that it's sector neutral. So it's looking for the high quality companies without taking on that same sector tilt that you typically will find within some of the factor-based products. And if I can throw off one additional one, I mentioned rising interest rates. We think investors should be aware of the interest rate sensitivity of their portfolios and be trying to hedge out or consider hedging out some of the interest rate sensitivity of the portfolios. And so products like LQDH, which is the hedged version of LQD, and IGHG, which is an iShares. I'm not sorry, not iShares. That's a ProShares investment grade rate hedge product. Those are going to provide you with the income that you would normally get from investment grade, but without taking on that interest rate risk that you typically find within a corporate bond ETF. So those are just some ETFs that we're watching to start the year that we think could do very well, and they're certainly going to gain interest, in our opinion, with investors.
All very interesting picks, and I particularly agree with the quality ETFs because we have seen that quality companies, those with excellent balance sheets and stable cash flows, they do particularly well when stock markets are very volatile. And thanks for the interesting discussion and for joining us today.
Thanks for having me. Look forward to the next time.
So that was Todd Rosenbluth. I'll now be joined by John Davey, CEO of Astoria. Astoria is an investment management firm with over $1 billion in assets under management and advisement. They specialized in ETF managed portfolios, and they recently released their 10 ETFs for 2022 report. So we will talk about his ETF picks for 2022. John, welcome back. Great to have you on the show.
Great to be back. Thank you so much.
So stocks had a rough start to the year 2022, and that is because investors are obviously worried about inflation, rising rates, and the Omicron variant. But they have rebounded nicely this week, and I wanted to start with your market outlook for 2022 because stocks had such a nice run last year and over the past 3 years, in fact. So one of the biggest questions for investors now is whether this bull market can stay alive in 2022. What are your thoughts?
Well, good question. I think that's the number one concern that people have is, will inflation, kind of continue? Is that going to kill the economic recovery? And, here at Astoria Advisors, we think that you should be preparing for higher inflation and, kind of embrace it. So, I think historically people are like trying to hedge their portfolio and just try and protect, but there are sectors and stocks that can benefit from higher inflation. And I think that's really where you want to be leaning on. So, from our perspective, there's kind of a couple of big things that govern our portfolio construction process for 2022. One is definitely to be preparing for higher inflation and positioning your portfolio away from tech and growth into more cyclically oriented sectors. Caveat that with saying that, we do expect, more rate hikes this year, and the, volatility will rise because I think last year was just a perfect storm of tremendous amount of inflows into, ETFs and mutual funds, a lot of monetary, stimulus and a lot of support. So it just kind of dampened volatility. But now, I think we're going to see some of that work in reverse where, the Fed is going to be hiking interest rates and potentially reducing their balance sheet. And I don't think we'll see another $1 trillion of inflows into stocks and mutual funds, this year, like we did last year. So, I think there's going to be a reason to have more diversifies in the portfolio, things like volatility strategies, utilities, healthcare, just to kind of have a little bit of a barbell approach. So that's, another big theme for us at Astoria Advisors. Finally, I would say that there is this more alternatives in the portfolio. Fixed income, I think, is separately challenged because of higher inflation and higher rates. So, what can you look at within the fixed income area or in, things like option overriding that are going to take advantage of, higher volatility and perhaps, limited upside in stock. So that's a combination of what we're thinking, leaning on inflation, barbell in your portfolio, and then just looking at more alternatives.
So as you alluded to, you released your 10 ETFs for 2022 report recently, and you also talked a little bit about the portfolio construction process. So could you expand on the themes that you took into account while structuring the ETF model portfolio for 2022? Which were the major themes you looked at?
So, first I'll say that, I've been putting together this top 10 ETF themes, top 10 ETF tickers for over a decade. And I know a lot of people are doing it now, but what I wanted to do, a decade ago was basically replicate what the sell side does when they put their, kind of forecasts for the year. A lot of those forecasts are not very actionable, so I wanted to make, my themes kind of actionable, and ETFs are a perfect segue for that. And then, the idea was to not just talk about, VTI and SPY and EFA, because, those aren't the most interesting tickers. I mean, obviously they're big and liquid and very important, but it was to have like unique tickers. And that kind of lends to how we manage our portfolios, which is, if the goal is to try and outperform the benchmark, and we are active managers, you have to do something different than a benchmark. So the benchmark, what I would say right now for a traditional 60-40 portfolio, there's a lot of tech and growth. There's a lot of traditional, spread products. And, I think if what we saw in the first week of January, and in reality, this trend of higher rates and higher inflation has been persistent for, much longer than the first week of January. But, it's been going on for several quarters now. That 60-40 benchmark portfolio just won't do well. So you'd have to lean on cyclically oriented, sectors. So we actually are the sub-advisor for the PPI ETF, which is the Axis Astoria inflation sensitive ETF. And, what that ETF does is a good example of how we're trying to position our portfolios, which is, we are going to lean on cyclicals. So the ETF includes banks, energy, industrial materials. That's a rules-based quantitative process for how we pick those stocks. And then we have an allocation towards commodities and an allocation towards tips. And in fairness, the tips allocation is meant to be more of a diversifier and dampen the volatility a little bit. So you'll see in our report, which investors can go to AstoriaAdvisors.com and look at the tickers. But we've got several inflation themes. We've got PPI. We've got BCI, which is the Aberdeen Bloomberg Commodity All Commodity ETF, and then we've got KBWB, the Invesco Bank Etf. I think those are very good ways to kind of play for higher inflation. We have a couple of dividend strategies in there, just because those are, I like to say that growth stocks were, all the rage the last decade, and particularly disruptive growth stocks. But good old boring dividend-paying stocks were largely ignored. So I think there's a place for that, in the portfolio. We have some alternative fixed income, alternative income sources, things like MLPs, things like real estate ETF, the NETL ETF. So those were kind of ways we were trying to get income. I mentioned a little bit before about defensive equities, so that's why you see in our list things like USMV, XLU, XLV. And then, fixed income, which is, it's very important that people have fixed income because they have liabilities that they have to meet. And things like SRLN and HYD are ways that, no doubt you're going down the duration curve and the credit curve. But they, they're areas where I think they're positive on a real rate adjusted basis. So I like those for income plays. And then the last ticker on our list is the International Developed Markets, the IHDG. And I think this could be the year, where international markets, on a relative basis, hold up. I know it's been a very big disappointment the last 10 years. But, there's only so much money that can go into U.S. and U.S. large cap index valuations are, near all-time highs. So I do think, rotating out of U.S. international does make sense.
Right. So you mentioned inflation. The portfolio does focus on inflation. There are 3 ETFs which are poised to benefit from rising inflation. And we know that inflation is one of the major concerns for investors lately. And this morning, we had a very hot inflation report. And for the purpose of reference, we are recording this on Wednesday, January the 12th in the afternoon. So the CPI index rose 7% in December from the previous year. And this was its fastest pace since June 1982. But this was in line with the consensus estimates. So that is why stock market rose after the release of the report. But I wanted to talk a little bit more about the 3 ETFs that you selected. In particular, the ETF that you launched recently. It is the AXS Astoria Inflation Sensitive ETF. Ticker symbol is PPI. It is very interesting ticker symbol. So this is an actively managed ETF, right? It is managed by you. Could you talk a little bit more about this ETF?
Sure. And I should obviously be disclose that we're the sub-advisor, and me highlighting this ETF on this podcast doesn't warrant, validation or recommendation. You should consult your financial advisor, for to see if it's suitable for you. Look, I think at the end of the day, for us, what we've tried to do is we run core ETF model portfolios, 60-40, 70-30, what have you. And they'll have, 10 to 12 tickers. And, about a year and a half ago, we started seeing, all the stimulus being put into the system. Supply chains were in shock. There's more demand than supply. So kind of economics 101 says prices go up. So we kind of said to our clients, like, look, we think that there's a tail risk that inflation may rise. And, the current 60-40 portfolio just won't weather that storm because we are strategically benchmarked. So we had to develop a sleeve of like 10 different inflation sensitive ETFs, things like banks, energy, industrial materials, commodities, agricultural commodities, physical commodities, gold, silver. So we were struggling with that. And we said, well, if we're struggling with it, we think that other advisors and investors will struggle. So we developed like a one ticker solution that we think would benefit and be able to embrace inflation. And as inflation goes up, as the economic cycle goes up, you tend to see energy bank stocks do well, as they've done all of last year. The energy sector in the S&P was up 53%. It led all of the sectors. Banks were up, I think, about 40%. So, that was the whole rationale for why we launched it. And then as far as the portfolio construction, it is the strategic bands are, somewhere around 70 to 80-ish% in cyclical sectors, just those 4 that I mentioned: banks, industrials, energy, materials. And for instance, like when we say, financials, we're talking about large cap money center banks or regional banks, right? We're not buying insurance companies or, Berkshire Hathaway, let's say. That's not what historically has done well when rates rise. So it's like specific sectors and subsectors that we're really gravitating towards. And then we have like commodities in there, 10-15% ish. And that's meant to be now more pro-cyclical commodities, things like energy and crude oil. As it is an actively managed strategy. So as we get later in the cycle, we would shift more towards, precious metals, let's say. And then we have tips in there, and tips are meant to kind of ground the volatility of the portfolio. So the stock selection process is rules-based, quantitative. That's kind of the world that I came from. It's a 5-factor model. It's essentially looking for cheap stocks with good growth prospects, high quality, strong momentum, and that have historically seen high sensitivity to CPI. We screen for the top most attractive stocks in the US and then 5 most attractive stocks internationally, because we think inflation is a global theme and we wanted this portfolio to be global. So that's what the ETF does. And then, there's some other tickers I mentioned in our list, BCI and KBWB, but that's effectively what the Axis Astoria inflation sensitive, PPI ETF does.
Right. Very interesting portfolio. The other 2, the first one is a banking ETF, ticker symbol KBWB. It's the Invesco Kpw Bank Etf, and financials did very well last year as well, and this year also they continue to do well, mainly because of rising interest rates. And Goldman Sachs, in fact, expects 4 interest rate hikes in 2022. And JP Morgan CEO Jamie Dimon recently said that he would be surprised if there are only 4 rate hikes. So if interest rates continue to rise, banks will continue to do well, and banks also benefit from the economic recovery. So KBWB makes a lot of sense. The other inflation beneficiary is a commodity ETF. It is the Aberdeen Bloomberg All Commodities Strategy ETF. Ticker symbol, as you mentioned, is BCI. This is also an actively managed ETF. It invests in 26 commodity futures. And we all know that commodities benefit from higher inflation, so that makes a lot of sense. Now, there are 2 dividend ETFs, SDY and SYPD. And this, for income-focused investors, there's an MLP ETF too. The ticker symbol is MLPA. So talk to us a little bit about these 2 dividend ETFs, and why did you select an MLP ETF? We know that energy did very well last year. It was the best performer, and energy continues to do well this year too. So do you expect oil to continue to go up? And why did you choose an MLP ETF instead of an oil ETF?
I think MLPs are very interesting. When we looked last year, there was a point of the year when we started noticing P ratios and for ETFs, and it was the cheapest P ratio that we could find for a fairly liquid asset class with size and ETF. So, I mean, it was very low single digit, kind of P ratios. So the way I look at MLPs is, it's a play on energy and oil. It's a play on inflation to some degree. And just in the context of like the last 10 years, all we've seen is like people proliferating into like deflationary strategies. So owning tech and growth stocks, buying bonds because bonds typically do well when you're riding down the interest rate curve. So anything that kind of does the opposite of that benefits from higher rates, higher inflation, cyclical recovery, was just out of vogue. So we just came across MLPs. We thought they were pretty cheap. According to the Global X fact sheet, the yield is 8.9%. So I thought that was a fairly attractive way to kind of get, income in the portfolio. And then, as I mentioned earlier on, we just think dividend paying stocks should be a way for investors to also, benefit from kind of rounding out their more cyclical oriented, sectors that they own in the portfolio. So SDY, SPY-D, these are ETFs that will yield you, somewhere around 3.5%. And I think that's fairly attractive in this era where, kind of real rates are pressured. So that's what we like for income.
And then you have 3 defensive equity ETFs, and these are USMV, that which is iShares MSCI USA Minimum Volatility Factor ETF. So this ETF tracks an index which uses a low volatility portfolio. And we know that rising rates, inflationary concerns, and the coronavirus, they continue to rattle investors this year and over the past few months. And history shows that low volatility stocks perform well when markets experience continued choppiness. So USMV makes a lot of sense. You have the healthcare spider fund over there, XLV, and that is also a defensive ETF. That also makes a lot of sense. Then you also have the utilities spider fund, ticker symbol XLU. Now, utilities are defensive areas of the market, but some experts believe that utilities tend to underperform when rates rise. So why did you select a utilities ETF in a rising rate environment? I was just interested in your thoughts.
Yeah, so it's a good question. We're trying to deliver the concept that okay, there's tech and growth in most people's legacy portfolio. And then we are adding, this idea that, okay, add cyclicals and inflationary assets. But, no doubt that will, by definition, if the economy starts to decelerate, cyclicals will, underperform, right? By definition, they are tied to the economic cycle. So we just thought like the idea is that you want to start to temper the portfolio and have, sectors in there and other cohorts that do well when, maybe you get a slight downtick in the economy. So things like healthcare, staples, utilities kind of always traditionally come to mind. We added Minvol in there because we thought Minvol, is interesting just from a, another defensive sector standpoint. Again, something like Minvol did not do well when you had, the parabolic move from, April 2020 up until, this year, right? It's been about more cyclicals and growth. So Minvol was kind of out of favor. So I think it's like a contrarian call for that one specifically.
Okay, that makes sense. And you mentioned technology, and you did allude to technology already being owned by investors because tech stocks, the mega cap tech stocks, they have become such a big part of the major indexes. Whether you own VOO or SPY, you already have a lot of exposure to mega cap tech stocks, which had a big 2021. And in fact, a big decade. They have been doing so well over the past decade. So when I look at your model portfolio, there is no exposure to tech. So do you expect mega cap tech to underperform this year?
I think like the message from us is that, some of these stocks are some of the best stocks that have ever been created and fascinating companies and fascinating balance sheets. But there are some that are super expensive. The way I like to say growth stocks is that it's okay to own high quality growth stocks at reasonable prices. But this idea of like, disruptive growth where, not profitable companies, I think those could continue to be challenged. They have been challenged for the better part of the last, 6 months or so. So the question is like, largely speaking, just pure technology, you have to like divide and make sure we're picking the right tech stocks and the right growth stocks. They do represent a big portion of that 60-40 in the S&P 500. So, I think on a return per unit of risk basis, that is more upside for cyclicals than there are for tech. Because I do think that the call from our side, how we model risk out, is that, I think inflation is probably going to remain high structurally. And, interest rates will remain, high. So I think tech was not on our list because it just didn't fit, in our portfolio. Now, do we own tech stocks vis-a-vis some of our, core U.S. ETFs? Of course, everyone does because tech makes up, 30% of the S&P. But it's just, this is like an idea generation piece, right? It's not literally meant for how we manage our portfolios. So.
Yeah, that's helpful. Another very interesting ETF I see is the home construction ETF, the iShares Home Construction ETF. The ticker symbol is ITP. And home building stocks had soared in 2020 as well as in 2021. And that was mainly because of record low mortgage rates and migration from urban centers to suburbs, which led to this housing boom. Now, these home building stocks are struggling this year, and that is mainly because of the possibility of interest rate hikes. So why do you expect the home builder ETF to continue to do well in 2022?
Well, I think you just said it right there. I mean, this migration from cities to suburbs, the cost of houses, has gone up quite a bit. I think home prices were up 20-25% last year. So, corporations have pricing power now, which is something that they haven't had for a while. So if you go to the store and you got to remodel your house, I mean, people are literally paying whatever price the contractor wants. whatever the price of that bathroom is going to cost you, people are paying for it. So it's kind of a unique situation, and I think that trend continues. I like to say, I'm going to paraphrase these numbers, but there's something like 380 million Americans in the U.S., but there's only something like 100 million homes. So this is the ultimate supply-demand imbalance when it comes to potential homeowners versus homes. So I like leaning on that that probability.
Yeah, I totally agree with the housing supply situation. The housing inventory is really low in the US, and there are so many buyers, potential buyers. And we have seen that wages have been rising. The labor market has been tightening. So rising wages would help some of these potential buyers, and their interest in home builders would continue to rise. Now, another very interesting ETF that I see is the blockchain ETF. The ticker symbol is BLOK. It is an actively managed blockchain ETF. And I know that the blockchain technology has a lot of potential, but investors usually associate blockchain with the cryptocurrencies, and we have seen that these blockchain-related stocks, they very closely track the price of Bitcoin or other major cryptocurrencies. And Bitcoin, we know, had soared to an all-time high of 69,000 in November last year. But since then, it has kind of collapsed, though slightly rebounded over this past few days. And similarly, BLOK, the blockchain ETF, had also done very well in 2021. But since then, since November, it has plunged more than 38%, tracking the collapse in the price of Bitcoin. So could you talk a little bit about the Block ETF, and also if you have any thoughts on investors owning cryptocurrencies in their portfolio?
Sure, and the idea behind that, we're not big crypto bulls. I think there's a lot of bark, but not a lot of bite. I think this is one of these things where if you've got, for $100 portfolio, you put a couple of dollars in something like blockchain. I do think that there's power in that technology. I prefer that than buying the actual cryptocurrency itself. Again, this is something where it's idiosyncratic. It's a 10, 15-year time horizon. Again, a lot of those companies are not going to be the most profitable companies in the world. So counter to what I just said before about, this being, a difficult year for unprofitable tech companies. I just think that, if there's one idiosyncratic theme that I like that I think could get interest in, it would be blockchain, and more comfortable with that because we can discount the cash flows, which you can't really do that when it comes to cryptocurrencies.
Okay, and then I wanted to talk about the two fixed income alternatives that you have. One is Spider Blackstone Senior Loan ETF. The ticker symbol is SRLN. And the second one is VanEck High Yield Muni ETF. The ticker symbol is HYD. And we know that fixed income bonds underperform in a rising rate environment. So tell us a little bit about these two ETFs, and would they benefit in the rising rate environment, or they are supposed to just, replace the bond component in the portfolio?
So good question. Most of the ag components are not keeping up with the rate of inflation and the rate of real rates. These two do, however. So SRLN are senior loans. So the loans reset as interest rates go up. So, it has a pretty attractive yield, 4.5%. HYD is just high yield muni bonds. It's about a 4% yield. So both of them are pretty attractive in what's been, a low interest rate environment. There's going to be a point where interest rates, the Fed funds and short term is going to go up just because, the Fed's hiking rates. So we're going to get to a point probably in the next year and a half, where perhaps you don't need to take risk in senior loans and high yield credit because you can get perhaps 2.5% risk-free. But for now, there's just this insatiable demand for income, and it's making, things like senior loans and munis just kind of bid just because everyone needs income. So I feel like, it's a good risk reward. It's obviously not going to replace the core AGG or B&D ETF positions because, those are effectively, much higher quality. But this is a way to kind of get yield in the portfolio.
Okay, quite interesting. Now, for real estate, you selected the Net Lease ETF. The ticker symbol is NETL. Talk a little bit about this ETF and why you selected it for the portfolio.
Sure. So triple net leases are interesting. They're long-term agreements in which, the leasee is responsible for most of the property expenses. At the end of the day, I think these have like more reliable sources of income. They pay a pretty attractive yield. I think like owning a triple net lease ETF in an ETF is better than just, if you were to just buy a triple net lease property in Texas somewhere and have to actually deal with the tenants. So I just thought it was interesting. It's a way to play, the boom in real estate, which real estate was a very good performance sector last year, because obviously it was, pretty significantly impacted during COVID. So it's a little bit of like a continued rebound trade. So this isn't meant to like replace any sort of fixed income, because these are equity securities that it's more, it has equity-like risk, I would say. So this would be, another way for you to get yield in a portfolio. According to the fact sheet from the issuer, it's about 4% yield. So I thought that was like a nice way to get yield and have something that's pretty idiosyncratic and pretty interesting. So we use that in our enhanced income portfolio at Astoria Advisors.
Right. Now, for international equities, you chose the WisdomTree International Hedged Quality Dividend Growth ETF. The ticker symbol is IHDG. And we know that US stocks have outperformed international stocks, developing as well as developed international stocks over the past many years. So obviously international equities now look much attractive in terms of valuations. So tell us a little bit about this ETF and why you selected this one for the portfolio.
Sure. So we tend to use a lot of the WisdomTree ETFs as our core ETF holdings. The quality growth suite from WisdomTree has, basically it's looking for high quality stocks, with good growth prospects. So the screens are usually ROE, ROA, half of that plus, looking at long-term growth estimates. I would say that international markets are something that have been also ignored for the last, 10, 13 years. We thought that they were pretty cheap. We just felt like, these were things that, the analogy I like to say is that, okay, if you look at the Swiss index, it was up 18, 19% last year. Nothing too fascinating, but at the end of the day, like that country is going to make goods that the rest of the world buys when the economy is going higher. So, something like the Italian market too, same thing with the German market. So it was a way to play the rebound and the cyclical recovery in the rest of the world. So that IHDG has developed international stocks.
Right. Now, you mentioned that Astoria has been doing this for the past 10 years or so, and we had you on the podcast last year as well to discuss your 10 ETFs for 2021. And I took a quick look at the portfolio again. You had some ETFs which did very, very well in 2021. This included the Energy Spider ETF, ticker symbol XLE, and the Bank Etf Kpw which you have included again in the portfolio. But there were certain ETFs in the portfolio which had an absolutely terrible performance, which included the ARK Genomic Revolution ETF, ARKG. This had an excellent performance in 2020, and it collapsed in 2021. There was China ETF2, ticker symbol MCHI, which had terrible performance last year. So overall, could you talk a little bit about the performance of last year's portfolio?
So when thinking back about last year's portfolio, I think there were a few bad tickers, but I think the concept of what we were trying to do of leaning on cyclical growth and commodities, those were out of consensus views at the time. Things like ARKG and things like China were just bad performers. I think the lesson to learn there is, it's good and interesting, but something like an ARKG, I think you really do need a 5-10 year time horizon. And I think Kathy's pretty skilled at picking secular winners over long periods of time, but there could be some pain on a mark-to-market basis. I know everyone loves talking about her investment strategy. I mean, she did put some pretty big numbers for years, so it was just bad timing on our part putting it in the portfolio. But the thesis of last year was more like, okay, play the cyclical rebound through commodities, cyclical stocks, physical commodities, cyclical growth sectors, which I think did pretty well on a relative basis. China, we've been bullish on China for a while. I still think long term there's a way to monetize the country and the demand. But we just couldn't foresee the government cracking down and putting more regulatory guardrails up. So that was challenging. But I still think China is worth owning in your portfolio on a long-term strategic basis. So that's what I would say about last year's list.
Exactly. Yes, those are the benefits of owning a diversified portfolio of ETFs, because there are many things which you cannot foresee at the beginning of the year, like you mentioned, the regulatory crackdown in China. So yes, owning a diversified portfolio of stocks or ETFs makes a lot of sense, because you would have some very big winners and some losers too, and overall the portfolio could do well. But that's all we have time for today. John, thank you for joining us.
Thank you so much for having me.
Thanks for listening. I hope you enjoyed the discussion with Todd and John. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. And also make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.